Alright, investors, in this video I want to show you how you can analyze shares, put your own custom assumptions and see how your assumption will affect the stock target price. For this we will be using the Financial Modeling Prep website. Simply go to here, to this website. I'll put the link down to the description of this video, and you can change the stock ticker over here. In my example, this is Apple shares, but you can replace it and put any ticker as you wish. For example, Microsoft, MSFT, or Alibaba shares with BABA stock ticker. And once you replace it, hit the enter button and you will have this page where you can see the company overview. As you can see, it's Apple shares. In this overview, you can see the historical price. You can see the about section where you see the description, the company management, the website, and then you see the earnings. This is very important. The green circle represents a actual EPS, and this circle without the color represents the forecasted or consensus EPS. As you can see, Apple company constantly beats EPS estimates in the sense that it posts actual earnings that are higher than consensus or estimated EPS estimated by investment analysts. And this is very important. If you see company constantly beating EPS estimates, there is a high probability that for the next reporting period, the company will also beat estimates, and this will positively affect the stock price. It may start rising. That's why monitor closely for at least 3 or 4 last quarters the EPS, and if you see positive trend, it means that there is a high probability that company will beat EPS for the next reporting period. Then you see analyst upgrades and downgrades. As you can see, 1 day ago, this brokerage company put the neutral rating or overweight rating, and you can see the buy rating here, who put it and how long it happened. I usually pay attention to the most recent upgrades or downgrades, such as 1 day ago, 1 week ago, or 10 days ago. These are more relevant and these give me a good picture. And I also monitor the changes in the ratings. If it changes to the negative side, it means that the analysts are pessimistic about the company and it may affect the stock price negatively. So the next thing we can go to is we can see companies' financial statements. In the financial statements, as you can see, there is an actual revenue. You can see the quarterly data, and you can use this data to extract trends to see what was the company's revenue in the previous quarter, and how did the company posted in the most recent quarter. You can also use Financial Modeling Prep income statement gross API endpoint to track changes from quarter to quarter or from year to year. This is important to monitor to make sure that the company's costs are not increasing, they are decreasing or staying the same, and the company's revenue is getting higher. It can tell you that the company is managing its costs efficiently. Also monitor the gross profit margin. This is very important, and compare it to the industry peers, to the industry average. And if the company has a higher margin comparing to its closest peers and more stable gross margin, for example, this can tell that the management is controlling its cost more efficiently. Then we go to financial ratios, but as usual, financial ratios should be compared to the closest peers and to industry averages. I'll put the link down to this video where you can see how using financial ratios you can calculate the stock target price. There is a price income or multiplicators valuation model that you can use together with DCF or DDM valuation model to calculate the stock target price. And if you like analyzing financial ratios, this video will be for you. Just search in the description section where I will be explaining how you can undertake equity valuation using financial ratios. But again, this should be compared to the industry average and to the closest company peers. Then in the analysis section, you can see the overall rating. As you can see, the company generates good cash flows. The discounted cash flow gives a 4. That's a good rating. Return on equity tells you how much the company is generating its revenue from the shareholders' equity. So the higher the number, the better. Return on assets tells you how much the company is generating revenue from its existing assets. So if the company have to invest in the new assets all the time and to generate revenue, that's not the good sign. But if the company is using its current or existing assets such as property, plant or equipment, longer term assets to generate a good level of revenue, that's a good sign. Also, they should be compared to the closest peers. You see the upgrades and downgrades as we saw on the first page, but you also see the target price changes over here. These are more recent target price changes. If you see a lot of investment analysts, they're changing their price upwards, this may indicate an investor high confidence. But in this case, we see that the UBS downgraded it slightly. It was 240, now it's 210. JP Morgan, it was 21. It upgraded it 8 days ago to 230, so it stays more optimistic about this stock. Barclays changed the rating downside to 173, and overall you can see based on 3 most recent analyst estimates, analyst target price calculations, they are downgrading it. So UBS downgraded and Barclays downgraded, so they are a little bit stay a little bit alerted, I should say. And you can also see the stock's current market price, so it's 213. So according to UBS, the stock is fairly valued right now. According to JP Morgan, the stock has some space, some small space for upside yet. And according to Barclays, the stock is overvalued right now because the current price is higher than its market price. So maybe Barclays is expecting some mid-term correction for the stock. But again, monitor this closely. Investment analysts regularly reconsider their target prices based on companies' actual financial statements. So also monitor when the company is posting financial statement. If they are posting better than expected numbers, this may push investment analysts to reconsider their ratings. That's why monitor financial statements and analyst target prices. So these numbers are changing regularly from quarter to quarter. Then you can see the DCF model. This is very important. DCF, it calculates the stock target price. So based on these assumptions, the projected stock target price according to DCF valuation model is 151. Current price is 230, which means that the stock is overvalued. But you can customize this thing. As you can see, there is a table where you can put your custom numbers so that this target price will be lower or higher depending on your assumptions. Well, how to get those assumptions? First, you can read different research papers from investment banks published by different investment analysts, search in Google and see what analysts think of your selected company, of your selected stock. The other option is to use financial modeling prep Playground. Playground is a great feature to test different API endpoints. First, register with FMP. I will put the link to the registration page where you can register. You can choose your package to use the financial modeling prep endpoints, and then you can follow the link. I will also put the link to description on this Playground page where you can see where you can test different API endpoints. And once you're on this page, it's called Financial Estimates. Simply put the stock symbol over here, choose the period. I'm choosing the annual for this video. And then you can see analyst estimations. So, for example, some analysts expect revenue. This is the low forecast, this is the high forecast, and this is the consensus, the average revenue forecast among different investment analysts. These are different years for your forecast, and you can take the average number over here, so sum these things up. We're not taking the old numbers, we're taking the coming annual revenue numbers. So these are what analysts expect. You can take the average number, or you can take the highest revenue average number calculated by different investment analysts and expect that for the next year, the Apple will show this revenue, for example. This is your estimation, but of course you can make it lower if you want to. So we have here 430. revenue expectation, and you can change it to 483. Let's say that you expect that to the next in the next year Apple will show 483 billion of revenue. So you can change this number over here to make it equal to 400. How much is that? 483 billion. This is the percentage. You change the percentage, and then you hit recalculate button over here. 485 are almost close, and as you can see, based on this assumption, if you think that the Apple will post 485 billion to the next for the year 2025, I'm sorry, the target price will be 268, which shows undervaluation and shows some growth potential from the current stock price. And by following the same logic, you can change other numbers. For example, you can change the total cash, or you can change the EBIT value. Just look over here, see the EBIT average. You can take the most recent number, or you can take the EBIT for 2026 for the next year, 140. And as you can see here, it is slightly higher, so you can lower this number over here and simply press recalculate. Let's change it to 28, 139, almost close to 140, and you can see how it resulted in the stock target price. We can put it even lower if you want to, but for this video, let's leave it like this. So this is very high revenue expectation, and maybe they will be able to post that revenue, maybe it will be lower, but please take into consideration that if the company will post lower revenue, you have to reconsider your DCF model, and the stock target price will be lower. It will look less attractive, and it may result in the stock correction. So you can change other things in the balance sheet. You can go to the company website, go to Apple and put investor relation, type in investor relations, and you can get an access to the most recent financial statements, analyst estimations, auditors reports, auditors notes, and by reading those notes you can see what they expect from the company. You can read the management notes, and by doing this, and also by reading investment analyst research papers, you can forecast and put your custom assumption on total cash, inventories, and so forth, and you can customize your DCF model and calculate your custom stock target price. Of course, if you want to get an Excel model and calculate the target price on Excel or in Google Sheets, I have a video for you. You can look at the description section of this video and find the link where I explain how to calculate the stock target price using the DCF model using Google Sheets. Also, you can customize the beta. Beta shows the risk of your stock comparing to the market. When I say market, I mean S&P 500. So the beta of 2, for example, tells that, in simple terms, the beta of 2 tells that the Apple stock is 2 times more volatile than the S&P 500, for example. So it is slightly more volatile with a beta 121, and you may say that the next year I expect Apple will be less volatile, and you can put beta 0.80, for example, or more volatile. You can put beta of 2 and see how your assumptions will change your projections. Then you can change the tax rate. For example, if you expect the tax rate will be lower, you can put the lower number and see how it will affect your DCF model. Also, the cost of equity, risk-free rate, it's the average rate among US Treasury yields. So they have different yields, US Treasury notes, US Treasury bonds maturing in 2 years, in 5 years, and 10 years, and it's the average yield among different maturities. And for example, if you expect the cost of money to get lower to the next year, you can decrease this number and see how this will affect your DCF. So this will basically affect the WACC, weighted average cost of capital, and it will which is a discounted rate. And by doing this, you can build your customized model and calculate the stock target price using the DCF valuation model and financial modeling prep website. So I hope my express guide was useful. Now you know how to analyze shares, how to undertake express equity valuation, how to see if your stock is strong fundamentally, and see investment analyst ratings. Thank you for watching this video. Please hit the like button and subscribe to my channel. Thank you so much for watching.